All right. Hey guys, how are you? I think we're going to go ahead and get started here. There's just a few of us on. Some other people might be coming in, but hopefully you can all see my screen. I am sharing my screen here. And I see that everyone's mic is muted, at least for now. That's great. And if there's questions at the end, I'll unmute you. And then I'll give you guys the ability to ask any questions of me about any of the research or anything else you'd like to talk about. Okay, so today I'm going to walk you through the Validea research website. What we do here at Validea is we build quantitative models based on strategies that have been outlined in books and or academic papers, and also other what I would consider quantitative like investing systems or analysis tools that may be useful to you as you look to research stocks and or find new stock or investment ideas. Most of the stuff I'm going to show you is related to stock and equity, but there are some tools related to ETFs as well. So let's just start by quickly, let me show you who the gurus are. I'm only going to spend a minute on this page, but when we talk about the gurus on the Validea website, what we're really talking about is investment strategies or models that have been extracted from books and or academic papers. All I did here is I clicked on gurus, and then as you come down, you can see all the different individuals and more importantly, the sources that we base these investment strategies on. So on Validea, there's 22 of these. I should note that what you're seeing, the view that you're seeing is the Validea professional view. There's two different levels of service. There's the standard and the professional. The professional shows you or gives you access to everything. Gives you access to all the different strategies on the website. So what you're seeing, what I'm going to show you when you're looking at this is you're seeing the Validea professional access. And the word professional shouldn't, it doesn't mean that it's only used or available to professionals. It's just a higher end sort of service that includes everything that we do here at Validea. So the first thing that I want to show you is something we call our guru analysis tool. So what guru analysis allows you to do, and I'm going to use Microsoft here to start. For any stock in the US market that you're interested in, you can basically see how the strategies we follow on Validea rate the particular company that you're interested in. So here I typed in the ticker symbol Microsoft, and what you're seeing is for the 22 strategies we run at Validea, how Microsoft scores based on its underlying fundamentals. Each of these strategies is different. So if I clicked into the twin momentum model based on Dishan Heng's academic work, it's going to be different than the Pim Van Vliet multi-factor model, which is going to be different from the Peter Lynch model. So each of these models is looking at a unique, distinct set of investment criteria. So let's just take a look at one. I just clicked into Pim Van Vliet. Here again, we're looking at Microsoft. This is a pretty straightforward strategy, but let me just walk you through it real quickly so you can kind of see what's in it. This strategy first wants to start out by looking at the largest stocks in the market. So it starts by looking at the 1,000 companies that are largest based on market cap. After that, it wants to see of those securities, what stocks are in the bottom 50% based on their underlying volatility or risk. So here it's looking at the standard deviation over the last 3 years, and it's saying it wants only the 50% of stocks that are in the bottom. So that's trying to uncover lower volatility type names. The next criteria is 12 minus 1 month momentum. So that's just a momentum statistic. It's saying, okay, let's take the 12-month return, exclude the 1 month return, and let's percentile rank stocks based on that. So this is trying to get stocks that are exhibiting more momentum versus stocks that aren't exhibiting momentum. And then it looks at the net payout yield, which is basically a way that the company can return cash to shareholders. It's the dividend yield, the share buyback yield. And then it does a final rank based on those two combined criteria. So that's an example of how one of these strategies works. If we click into another one, let's say the Peter Lynch model, based on his work and One Up on Wall Street, we can see a whole different set of investment criteria. So here, it's basically considering Microsoft a fast grower. It's looking at the PEG ratio. It's looking at the sales and the PE ratio, inventory to sales, EPS growth rate, total debt to equity. and a whole bunch of other criteria. So the point, I think, is that for the stocks that are in your portfolio that you're interested in, you can come into this GURU analysis tool and you can see how they score according to one or many of the models we run. You may start to key in on a certain model or set of models that are more appealing or attractive to you, or maybe you understand a little bit more. Or you might just be looking at, like, holistically, like, does this stock look pretty good? What I would say is that when you see companies that score, so here's Microsoft, you'll notice it gets 70% or better generally is like good in our system. So you have 1, 2, 3, 4, 5, 6, 7 strategies that rank Microsoft 70% or better. When you get that many strategies sort of agreeing on a stock simultaneously, it's usually a good sign that, at least from a fundamental standpoint, the stock is scoring high and looking good through a whole series or lens of different fundamental criteria. So the GURU analysis tool is there for you to use for stocks that you're interested in or that you hold in your portfolio. The next thing I wanted to show you was something that we call our model portfolios, and we do a few things with model portfolios on our website. What I'm showing here first is the GURU-based model portfolios. So the GURU analysis engine that I just showed you, the ability to score and analyze stocks, if you remember, there was scores associated with each GURU for all the stock we were looking at. So we were looking at Microsoft and it had 70%, 90%, whatever it was. Well, that scoring system can be used to construct model portfolios and can be used to construct investment screens. So here we're going to focus on the model portfolios a little bit, because what we've done is we've tried to take these strategies, these quantitative models, and we've tried to say, okay, how do you actually implement them in followable investment strategies that can give you a chance to grow your wealth and potentially outperform the market over time. And that's what these model portfolios are here to do. So we run both 10 and 20 stock model portfolios. We run portfolios that are rebalanced monthly, quarterly, annually, and tax efficiently, and I'll explain that in a minute. And then we also have this drop-down chart, which allows you to go all the way back to when we first started tracking these portfolios in any given year, and also on trailing time periods to see how these strategies have performed. But let's just talk about what we mean by rebalancing for a second. When we're talking monthly, quarterly, or annual rebalancing, what we're talking about is those specific portfolios are rebalanced either on a monthly basis, on a quarterly basis, or on an annual basis. So some investors like, a monthly raw rebalancing where the strategies rerun, the top scoring stocks come in, and new names are brought into the portfolio, and then the names that don't score as high anymore are removed from the portfolio. But monthly might be too much for someone, so maybe quarterly is a little bit better. So it's a lower turnover strategy. And then annual is even less. That's once a year in July, where we rebalance our annual portfolios. And all these, if we were to switch it to say, the default view, when you come into this page, what you're seeing here is the optimal for each strategy. You're seeing the optimal size portfolio and the optimal rebalancing period for each strategy. So what that means is, under the Deshaun Hang twin momentum model, the optimal, the best performing portfolio over the long run is the 10 stock monthly portfolio. For the Mohan Ram price to book to growth strategy, it's the 10 stock tax efficient portfolio. So each of these strategies is basically does better in some type of optimal combination, whether it's 10 or 20 stocks or under one of these rebalancing frequencies. What do we mean by tax efficient? I just want to spend a minute on here, because anytime you're following a systematic based approach and you're deploying it with a monthly or quarterly rebalancing schedule, you're obviously going to have a lot of turnover in that strategy. So what we've done, and I think from what I know, we might be the only sort of modeling firm to do this. Maybe I'm wrong, but and maybe somebody can tell me if anyone else is doing this when I open it up for questions. But we actually have built what we consider a tax efficient systematic way to rebalance these portfolios. So what that means is, when we're rebalancing these portfolios tax efficiently, what we're doing is we're holding our winning positions for at least 12 months. and we're harvesting our losing positions that we have losses on in so long that they don't meet the underlying strategy's criteria anymore. So when you do that, what you get as you get synced up to the model is you get a tax efficient way to deploy systematic models like this. So it's kind of like an intelligent way to say, okay, if I've been holding, if you're following a model and you've held a stock 10 months and you're up 50% on it and you're, in it with taxable money, obviously it probably doesn't make sense to sell that stock, even if it falls in score. So what our system is set up to do is look at that and say, okay, let's hold it until 12 months. Yeah, the stock doesn't score high according to the model that it was originally selected by, but it doesn't make sense to sell it and pay short-term capital gains on it. It makes sense to hold it and wait until we hit that long-term capital gain 12-month mark. So let's just use an example. Let's say someone wants to come in and say, okay, 10 stocks is probably a little bit too risky for me. So I want 20 stocks. And I sort of like the idea of doing it tax efficiently. So I'm going to choose a tax efficient rebalancing, what we're on here. And then I'm looking at the list. I don't really know Partha Mohan Ram. I've never heard of this guy, Dishan Hang. Validea is telling me they have a twin momentum model. I know who Marty Zwag is, but he's maybe more of a macro guy. He was on Louis Rukeyser's. Peter Lynch, definitely know, great stock picker, ran the Fidelity Magellan Fund, one of the best performing mutual fund managers ever. Maybe this strategy appeals to you. What happens when you click in? So here we're looking at the Peter Lynch 20 stock tax efficient model portfolio, and we're looking at its performance since inception here. We can again change that. To change it, we see the long-term performance chart back to 03. I just hit this little button right here. It says full return history. You can see the full return history of the portfolio. You can see the years it's shined. You can see the years that it's underperformed. And by the way, all of our models will go through years or multiple years of underperformance. This investing system is not perfect. It's not bulletproof. Anybody that tells you that they have strategies like that, I would suggest kind of just heading for the hills. This isn't something that, performance is guaranteed by any means whatsoever. These are investment strategies that will be influenced by the market, by the stocks they pick, and by the things that are influencing the market, and they don't always work. That's very important. We always want to make sure we're being fair and honest with people that are interested in Validea. This isn't some magic formula where you're guaranteed outperformance if you follow one of these models. What you are guaranteed is a disciplined, systematic way to select stocks fundamentally across a lot of different strategies, and that's essentially what we're doing, what I'm showing you here. So as I'm coming down into the model portfolio, we're seeing 20 securities. So these are 20 stocks that at some point were added to the Lynch model portfolio. We obviously have some losses on some. We have some real nice gains on some others. Because this is one of the tax efficient models, we've obviously held some of these stocks for a long time. But they will eventually sort of get changed. And so as you can see in this portfolio, we last rebalanced it on September 18th. The next rebalancing is on October 16th. On the last rebalancing, we had 2 stocks come in, we had 2 stocks remove. We tell you exactly what those stocks are. When we rebalance our portfolios, you get an email notification basically saying, here are the top scoring stock, here the portfolios have been updated. And then some people do want to come in and see the current portfolio. If you were to just get decked up to it at the current time, here's what the current, if the stocks that score the highest according to the Lynch strategy right now, here's what they are. The only problem with that is that you'd be deviating from the tax efficient nature if you wanted to get synced up to the tax efficient one. So to some extent, there is a period when you want to get into one of these tax efficient strategies. It takes some time to get synced up to the model with the tax efficient aspect to it. But let me just show you another one. Let's go back to the model portfolios. I'm going to contrast that with a 10 stock monthly rebalance portfolio. So under that size portfolio and rebalancing frequency, we have twin momentum is the best performer historically, price to book to growth, and small cap growth, which is based on the Motley Fool. Let's say you're familiar with the Fool. Maybe you've seen their newsletters, so it's a name you're somewhat familiar with. You may not know the strategy exactly, but since you know about them and you heard about them, that one looks kind of interesting to you. So here, all we're doing is we're coming into the model portfolio for the Motley Fool small cap growth investor strategy. And we can scroll down. We're going to see the exact same things that I showed you on the other page, only it's going to be obviously a different set of stocks and a different number of stocks, because here we're looking at the 10 stock portfolio. Before we were looking at the Lynch 20 stock tax efficient portfolio. So this is going to have a lot more changes. So last time we rebalanced the portfolio, which was in September, we had, Zoom come in, eGain come in, Collectors Universe, Land Lake Industries, and then we had a whole bunch of stocks come out. I think for people that want to be more active, that have IRAs where they're not going to get hit with the taxes, certainly the monthly or quarterly rebalanced portfolios, especially for some strategies, can be very good. We tend to find that the strategies that are more growthy and momentum tend to do a little bit better with more frequent rebalancings, whereas the value-based ones and quality tend to do, to some extent, better with less changes. So that's the model portfolios. What I wanted to now show you was another way that you can generate investment ideas using the system, but not in the context of a model portfolio necessarily, but in the terms of a stock screen. So here, all we're doing is, this is called the Guru Stock Screener, and it allows us to choose any of the Guru strategies we run and filter stocks that pass that criteria. So let's just say we're a big Warren Buffett fan, and we want to see how Validea has implemented the Warren Buffett model, which we base on the book Buffettology. So all I did here is I added Warren Buffett, strong or some interest. That means I'm looking for stocks that generally score 80% or better. And we get a whole big long list of stocks down here. If I sort this by market cap, it'll give us, and then look at the largest stocks. It gives us more of a representation of the stocks that Buffett might be interested in. Of course, he owns Apple, is his largest position. He also owns MasterCard. I know he's owned United Health in the past. So anyways, these are, as you can see, these are big blue chip type quality companies that meet our Buffett model, that also, I think, kind of would align with how Buffett invests Berkshire Hathaway's money. But that's just the starting point for the Guru Stock Screener. You can then combine, you could say, okay, I want to combine the Buffett model with any of these other models. Or if you wanted to say, well, rather than choosing a Guru because I'm just trying to find stocks that score highly based on the Validea system, I want to see all stocks that pass 6 or more strategies with strong or some interest. So here we have a list of stocks, quite a long list, probably too long to do anything with. But if we then wanted to add in other investment criteria, there's a whole bunch of things we can do. We can filter on sector. We can filter on industry. You can filter on countries based on, we have ADRs in our universe. This isn't like foreign stocks, but their ADRs are in here. So you could identify stocks that way. We have valuation criteria you can add in, some unique stuff here, growth and profitability criteria, sales and earnings growth, momentum and price criteria. If you want stocks that are sort of in an uptrend, you can use some of these things to uncover that. And then quality and ownership criteria. So things like return on equity, even a 10-year average return on equity, return on capital, long-term debt to equity, the current ratio, insider ownership. We also have the F score, which is based on Piotrowski's work, and the G score, which is based on Mohan Ram's work. So there's quite a bit of things you can do here to dig in and really uncover investment ideas using the Guru Stock Screener and sort of customize it to the way that you want, it. Okay. Before I show you, actually, let me show you this. This is going to be another, I'm going to flip over. I'm going to get off the Guru strategies for a second and flip over to something we call our Factor Report. Now, what the Factor Report is looking at stocks through various investment factors. So on the one side, you have these Guru strategies, which are like a combination of unique, what are criteria or factors, you could even call it, that have been basically implemented together within an investment strategy. The Factor Report is another way that gives you insight into how a stock stacks up based on sort of the well-known investing factors that have been discussed either in the academic world and or other places. So here we're looking at Microsoft. You have a table here that gives you a lot of fundamental just data points. If you're interested in sort of seeing, you know, more on the company, I mean, I'm not going to go through it all, but you can see there's some valuation stuff. There's some profitability things, growth rates here. So that's just quickly, we give you a summary of what the company does. So of course, many of the companies that you would find on Validea, you may not know what they do. Microsoft, well, we know what they do, but there's a lot of companies you're not going to know. And so having an overview, like just a company capsule here is important. But as we scroll down, what you're seeing is the overall rank of Microsoft, but it's based on these factors. So Microsoft ranks pretty low on the value factor, which is kind of understandable. It's not super cheap here, right? Relative to other stocks in the market, but it does rank really high on the quality factor. And that's what we would expect. It also ranks pretty well on the negative quality factor. For negative quality, the lower number is better. This is the only factor where lower is better. So what we're trying to do is say, okay, what are some of the negative quality screens that you would want to look at, and you would want to avoid those types of companies. So Microsoft actually scores pretty low on negative quality, obviously on momentum, because a lot of these big cap tech stocks have just been very strong performers. So it rates very strong on momentum. And then it also rates pretty good on low volatility. So even though it's been a really good performing stock, it doesn't have a lot of deviation in that performance. And there we're looking at standard deviation and the beta coefficient. As you come down that page, we're giving you other stocks that look similar to Microsoft. So these aren't necessarily stocks in the software space as much as they are stocks that score high based on comp, because of their factor rankings look similar. I just thought this was interesting. I was looking at P&G earlier. I was going to give that as an example, but what I found interesting with that is, you know, the factor scores, the comparable stocks are what you would expect: Pepsi, Mondelez, Unilever, Colgate. So these are, you know, consumer staple companies. At least from a factor profile, these things are all looking similar. So when we see that, at least we know our system's working correctly, that similar type stocks are the comparable stocks based on the factors. We do have a factor screener. Where's the factor screener? Well, actually, let me go here. Oh, you know what? I know what. Yeah. So the factor screener right now, I think we're just in the process of tweaking that a little bit, but I think probably by next week that will be back up on the site. We did have something we had to change. I forgot. The two other things that I wanted to show you related to stocks, there are some predefined screens down here. So remember I showed you the Guru stock screener. If you want to just in the footer, see some more predefined screens that we came up with, whether it's low volatility stocks, wide moat stocks, high quality stocks. There's some predefined screens down there that might help you get started. Those don't bring you into the Guru stock screener. Those kind of bring you into other pages, but I'm just pointing out that those do exist for you if you're interested. Okay. The few other things I wanted to show you, we're doing pretty good on time here, so I appreciate everyone kind of hanging in. We're going to pivot over to something that is a little bit newer for us, and it's this Etf Factor Report. So obviously, ETFs have become a lot more popular and utilized by investors. As you know, with ETFs, if it's a passive ETF, or maybe you don't know this, but with passive ETFs, you know, they have a requirement to display their holdings on a daily basis. So because of that, you can do a lot of things with those underlying holdings. You can say, okay, is this a value ETF? Is this a growth ETF? Is this a, you know, high quality ETF? Like, what are, in terms of underneath the hood, what are the characteristics of the stocks that are held by the ETF? And so let's look at QVal here, which we know the guys over at Alpha Architect. They're good friends of ours. They run the Alpha Architect quantitative value ETF. We know it's a value strategy. And here, what you're seeing for QVal, and we do this on over 600 US equity ETFs. We tell you what the total assets in the fund are, expense ratio, active share versus the S&P, which if you're not sure what active share is, you can click in here. It basically is how different you look than the S&P 500. The fee you're paying for active share, And then a couple other interesting metrics that, are for ETF investors might be useful statistics. Coming down, you get to see basically the same factor profile or factor scores that we saw on the stock side. But what we're doing here is we're looking at the underlying holdings in the ETF. So first is size. So this is kind of it's not small, it's not super big, it's sort of middle. So it's like a mid-cap strategy, really high on value. And here are the value metrics that the companies rank really high on. Quality is decent. Value is the most important metric, though, obviously, in this ETF. I know that for a fact. And then you can come down. So this is just a way for any ETF that you're interested in investing in, looking at, or having in your portfolio. If you want to see the factor exposures, and then if you want to see the weights relative to the S&P 500, the highest weights and the lowest weights, you can see that along with the industry as well. And then coming down further, there's this comparable ETF table, which just like I showed you on the factor scores, factor reports for the stocks, we have comparable ETFs in the value category that look similar. So that can be another way to generate interesting investing ideas if you're looking for other ETFs, maybe that are a little bit more cost effective or that have slightly different sector or industry exposures. We then have a Etf Screener. No, I'm not going to deal with that. That's on my end. You guys, if you guys click that after the thing, you won't get it. I'm cookied, so I got an error on the Etf Screener report. But if anyone goes in to use it after this, you should be able to bring that up. You shouldn't get that error. If you do, please let me know, because that was something that's specific to my session. Okay, so let me just move over. So I've showed you sort of the way that you can research individual ETF ideas. We do have a set of ETF model portfolios that we run. So before I showed you the stock portfolios, those are 10 and 20 stock portfolios that hold and select the stocks based on the guru strategies. Here, what I'm going to do is show you ETF model portfolios we run that are based on different approaches. So they're really broken down into 3 different sort of parts of the ETF model portfolio tool. There's factor portfolios. So these are selecting ETFs with the most momentum, value, or macro factors that basically look attractive. And we run these in the context of a model portfolio. I'll click into one and show you one in a second. But then we also run sector-based portfolios. So what sectors are exhibiting the most momentum? What sectors are exhibiting the most value? We run those portfolios. And by the way, we run these long only and with trend. So we basically run long only portfolios and portfolios with trend following, which is an overlay that looks to get out of the portfolio, out of the positions if the market starts to exhibit like some serious downtrend characteristics. And then what we have is risk managed portfolios. So I would consider these, I guess, alternatives to the 60-40. They're things like the permanent portfolio, Dalio's all-weather portfolio, and more unique portfolios like protective asset allocation and generalized protective momentum. So to start, let's look at a sector portfolio with momentum. And you're getting comparable. These are sort of giving you market-like returns in some cases, not in all cases, but in some cases. But some investors are they like sort of sector-based approaches. So here, what you're seeing is the sector rotation portfolio, and these are the ETFs that are exhibiting the highest degree of momentum as of the last rebalancing. We didn't make any changes as of the last rebalancing, but you have the technology select spider in here, material spider, retail, healthcare, and consumer staples. So it's actually kind of a nice diversified mix, but based on our momentum score, it was these 5 ETFs, each accounting for a 20% position in the portfolio that did the best. Obviously, technology's been in here a while. You can see this goes back to 2014. I mean, that's how long technology has been delivering superior momentum versus other sectors. So what a momentum strategy does is it keeps you in the areas of the market that are exhibiting the most price strength. Looking at a risk managed portfolio here, let's look at a protective asset allocation. This is kind of a unique one. So what protective asset allocation looks to do is it starts by saying, okay, I'm going to allocate among 12 different asset classes. So it looks at the S&P 500, the Russell 2000, NASDAQ 100, European equities, Japanese equities, emerging markets, treasury bonds, high yield bonds, corporate bonds, commodities, gold, and real estate. And then it says, you know, I want this strategy is going to be invested in the 6 asset classes that are exhibiting the strongest momentum. So again, this momentum sort of idea is coming back in with this strategy. So it's going to allocate you to the areas of the market that are exhibiting the most price strength. But then what it has the ability to do, if 6 of those categories are going to a downtrend, the whole portfolio has the ability to move to what's called the crash protection stance. So what the authors of this paper tested was when you have that many assets, a lot of them different, that go into a downtrend simultaneously, it's usually a signal that there's some sort of problem, there's some sort of weakness, there's cracks in the surface in the market. And so it makes sense to raise cash to protect capital. And that's what this strategy tries to do. And the generalized momentum protective strategy, which is another portfolio we run, is a similar version, but that takes into consideration correlation analysis. So the holdings that it's selecting are the ones that are least correlated with each other. Just a few other things. We do have on Validea, there's a trend following system. So this is just applying our trend following signal to some of the most popular asset classes out there, other asset classes that you might be interested in, all of our guru portfolios, investment styles, sectors, and more. So what this is basically looking to do is this will move in and out of the asset class when the technical start to deteriorate, it'll move out. And when things get better, it'll start to move back in. So some people like to utilize trend following to a degree in the way that they run their portfolio, again, for downside protection. But, you know, there's always 2 decisions in timing, right? There's a decision to get out and the decision to get back in. Normally, you know, timing systems are really tough in general because they get it wrong a lot. But especially if you're an individual sort of trying to time the market, that's pretty much impossible because it's, you know, your own emotions and everything get in the way. So we think if you're going to try to time, you know, doing it systematically is going to be a superior way to do it over the long run. And if you click into any one of these, we'll give you the details behind it. So here we were able to apply the trend following system back to 1971 for the S&P 500, 1987 for the Russell, you know, 2005 for emerging markets. And in some cases, the trend following performance actually has done better than buy and hold. The max losses are certainly a lot less in most cases, as you would expect, because the trend following has the ability to get out. Whereas the regular buy and hold, you know, those are just staying with it thick and thin. So you're going to realize the max drawdown if you're in there on those specific ones. Okay, there's a market valuation tool, which is a tool that allows you to see based on a bunch of different market statistics where the market stands from a valuation standpoint. And then you can sort of slice it and dice it to get down to a more granular level. So I'm not going to go into this in detail, but this is just something that you're not getting really any actionable idea here other than, you know, is the market over or undervalued, or segments of the market over or undervalued relative to each other and relative to their historical levels. So that's something that, you know, some investors like to sort of think about when they're making allocations to equities. So that tool is available on Validea. My Validea is, and a lot of people don't always know this, this is like a tracking system. So you can enter your portfolio into my Validea and allow you to see how your stocks score across the guru model. So if you have, you know, a watch list, or if you have a portfolio of 20 names or something that you own over at Fidelity or Schwab or wherever, you can get those in here, and then you can see the fundamental view. You can see the regular guru view. So this is like the guru standard, how the stocks score. You can see the guru professionals, or the ones that are in the pro product, because they are broken out. And then we also give you a technical view, so you can see sort of some basic stuff in here. So you can add stock, you can add your portfolio of stocks in. You can also follow, you can choose guru strategies to track. So here I just have some loaded in, and this is going to send you the latest upgrades or downgrades from the guru model. You can put in the portfolio that you want to follow. So it's coming up here in a minute. So here it's just, you know, if you decide to follow like a couple portfolios, you can put those in here. And then when our system rebalances and we notify you, we're going to give you exactly, the email is going to be customized to tell you exactly, here's the 4 portfolios. You can click off real quickly and see the changes. And then there's a couple other things, the ETF portfolios as well, my industries and my country. So there's kind of this alerting system that's been built into the My Validea portion of the site that can kind of keep you updated as to changes that are happening through the strategies. So that's basically it. I guess the only other thing is we do have a lot of the people on this may have come to us from our blog. We have a blog and our stuff does get picked up in different places. And we do a lot of our own writing and we do podcasting as well. So if you are on the blog list, you've probably gotten many of our articles. I mean, I write a column, Jack, my partner, writes a column. We do interviews, we have a podcast, and on that podcast, we have guests on occasion. We just actually sat down yesterday with John Rickenthaler of Morningstar, who's been at Morningstar since the late 80s. So that was a good discussion around the fund business and the changes in the investment landscape over time. And we put those out on Apple and on YouTube. So if you're into listening to podcasts and investing podcasts, please check us out. That's always something we always appreciate the support. We sort of just do that to share our knowledge and stuff. I mean, we obviously don't make a lot of money on the podcast. It's just a way for us to get our thoughts and stuff out there. And generally the feedback has been pretty good. So if you are a listener, if you do end up listening, we certainly appreciate that. So maybe what I'll do is see if I can figure out a way to unmute. I'm going to go ahead and unmute. I'm going to ask to unmute you. And then if you don't have any questions, that's fine. If you do have a question, you should be able to talk. So let me see if I can quickly do this. If you want to keep your mic on mute, then that's totally fine. But I'm going to unmute you here in Zoom. I'll see if I can figure this out. So let's see if I can do it here. Okay. So I'll just hang tight. If anybody wants to ask me anything, they can go ahead. The other thing I'll mention just before I open it up, if no one has any questions, that's fine too. But I mean, you can always, if you like to talk to me directly, certainly scheduling a call or something like that is something we're open to too. We do that with investors that are interested in learning more. So. I know it's a lot to take in. There's a lot on the site. Hopefully you guys found that somewhat interesting. I don't know if we have current subscribers on. A lot of times with these webinars, you know, existing subscribers come on just to kind of get an overview and better feel for what we're doing. And then, you know, people that aren't subscribed also join. Let's give it one more minute. Okay. Well, listen, guys, thank you guys very much. It's Friday afternoon, so I hope everyone has a good end of the week and a good weekend. Yeah, just give us a call or shoot me an email if you have any specific questions. Otherwise, we look forward to seeing you on Validea. And thanks so much.
Hey, thanks for your time, Justin.
Thank you.